Okay, folks, I think today it's real important that you grab your pen and paper. You may have to rewind a little bit. You may have to stop, take notes. You may have to contemplate, but you're about to get an education that I would argue would cost you $250,000, 4 years in a college degree, would not be able to give you the education you're getting today. Today's guest is the one and only Barry James Dyke. He is the author of 3 different books: Guaranteed Income, Pirates of Manhattan 1 and 2. Pirates of Manhattan 1 shook the world. This was back in 2007. Shortly after that, we had the major correction in the marketplace, and Barry was able to identify, prior to it happening, all of the thievery, the lies, and the manipulation that goes on Wall Street. Tremendous, tremendous book. Highly recommended. As a matter of fact, at the end of this video, if you want a copy of Barry's book, we will send it to you, providing you book an appointment and we sit down and spend a free financial audit. We will then give you a copy of the book. It's amazing. He has 3 books. You get to choose whichever one it would be. From beginning of time for me, as I stepped into this business, the very first book I read was Barry's book, and it enlightened the world about how on Wall Street, the retail folks, guys like gals like me and you, are told one thing while the institutions take their money and buy something different. So what Barry began to realize is there's a difference between how they operate versus how we operate. And I don't mean they as far as how they identify themselves. I'm talking about the corruption that goes on Wall Street. Anyway, without any further ado, I want to say hello to Barry.
Good to see you, Rob.
Barry, thank you so much for coming into office today. I'm honored. I'm thrilled. The whole team right behind us is taking notes. I want all the people that watch this video on all the different channels to take notes as much as they possibly can, because I think right now we're in unprecedented times. I know that history doesn't repeat itself, but it does rhyme. And we're in a bear market with the S&P. We're in a bear market right now with the NASDAQ. The Dow's about to approach a bear market. I know Bitcoin is 70% off its high. And at the end of the day, that's just the beginning of the beginning. And your information and what you serve for the world. Folks, if anyone watched the show 24, this is the Jack Bauer of finance. He is here to tell you the truth with integrity, and he doesn't care if it hurts the feelings of the people that are making billions of dollars. And Barry, I got to tell you, I'm so grateful that you're here. Once again, thank you so much. Where do we start?
My pleasure. Well, thank you for having me, Rob, and thank you for helping push back the frontiers of ignorance, as my old friend Nelson Nash would say.
Nelson Nash.
So it's been a long journey, as you know, since the first book has come out. But if people go to barrymajamesdyke.com, they can find out a little bit more of me in the book and so forth.
Yeah, and to be clear, that's Barry James Dyke, DYKE.com. There is a beautiful website that breaks down the books.
Yeah. So they can get the books there, but then they have some. I also have a podcast, the Economic Warrior channel, where I've interviewed economists and people from the very far left to the very far right. I really don't care as long as they tell the truth.
Yeah, and you're in demand, right? I mean, you stepped on the global stage back in 2007 when you told the truth about Wall Street. Is that correct?
So in any event, so I wrote the first book. I'm not a god or anything. I'm a good researcher, and so I just wanted to figure out how a lot of these things worked, and I intuitively knew it because I had a benefits business, I had a pension business, which I had sold to an insurance company, and I owned a third-party administration firm, and I knew a lot of the stuff intuitively didn't work. And then we had good mentors like Bob Castellan from Leap and Nelson, and I intuitively understood a lot of these financial products sold, such as mutual funds, and now it's getting much worse. They'd really I intuitively knew they didn't work.
Yeah. So Barry, we're going to go step by step on your journey, if you don't mind.
Sure.
And before we get into how you first got into our business, because for you had mentioned to me off camera that even as a little kid, you liked to take things apart to see how they were built. Long before you first started working in the technology industry, growing up, where did you grow up?
Grew up in Andover, Massachusetts, and north of Boston. It was a beautiful place to grow up. It was a great town. It was a wonderful place to grow up in, and had friends like Jay Leno, who was a old family friend, used to hang around the house, and I had. Yeah.
Are you serious?
No, yeah,
I didn't know that. That's amazing.
Jay's an old friend, and but I was really blessed that I had really good parents. And
did you go to the schoolyard with Jay Leno? Were you guys playing
Well, my brother and Jay were best friends.
May he rest in peace.
And,
yep.
and then So, unfortunately, my father had really wonderful parents. My father was an executive for an insurance company, and John Hancock at the time. Then he died early.
And your dad was in the Marines, correct?
Yeah, he was Marine, Semper Fi. So he was a very tough guy, very strong guy, and very fundamental. But when he was dying from cancer, we talked a lot about economics and things like that. And he always said, son, economics is at the core of the world's problems. And so I was always fascinated from that point on.
That's amazing. So let me ask you this. So like a basketball coach's son, sometimes they're gym rats. You were the son of a person that was into the economy, a powerful guy as far as military background.
My father was a very, very bright guy. And
what were some of the things he taught you at an age?
Well,
because I have a lot of entrepreneurs that watch my show.
Yeah, well, so a lot of things, you don't, a lot of things was how to manage debt. He really hated debt because he was a child of the Depression, and he saw what the banks did during the Great Depression too, and he was he worked, and he was really he understood a lot of the stuff intuitively, and so make a long story short, but it was a great place to grow up in, but before he died, we talked a lot about economics, and he said, if you really want to control people, understand people, you have to understand economics. So,
and how old were you at this point? Do you remember?
I was right around 21, 22, 23.
Okay.
So that then I got into I first worked in radio and communications, and then I worked for
what kind of radio? Were you like
I
behind
worked
the
actually
mic?
in a radio station. I was actually spent a lot of time in radio stations, and actually went into. I worked for RCA Global. I had a job where I actually had an office in Boston, office in Broad Street down in Lower Manhattan, and so I was and the first telecommunication, internet, and prior to the internet. So and then I got involved in a high tech company, and when I was 25, 26, I had my first Porsche, so
you had a Porsche?
I still like them. It's one of my vices.
Was it convertible?
No, it was a 944, whatever it was, but it was a dog of a car, but it was my first one. And,
wow. And your dad had passed away at this point?
Yeah, my dad had passed away, and so.
What about your mom?
My mom, she was I had great parents, but she had a stroke when I was in my 20s, but she was a very, very good, great, powerful example, very honest, hardworking people. She was an automotive accountant, and
automotive accountant. Wow.
Yeah,
I'm sorry. Back to Hancock. What did your dad actually do there?
My father he was head of claims for John Hancock for years, and then he got into the pension business, and he was really, really successful during the end of his life. But then he got cancer, and it was really very sad.
But I'm sorry. May he rest in peace. Yeah. Somewhere in this, though, you maybe from the beginning, but you've always had a desire to help the person that wasn't educated.
Yeah,
that's what I'm learning as.
I in tech, because tech was really big back then, So I kind of stumbled into. I wanted to be entrepreneurial, and when I was 14, I had my first business mowing lawns and things like that. Yeah, so no one else would mow lawns and whatever. But I was 14, I had more cash than anyone else, So what
did you do with it?
Oh, I bought hockey equipment, all the teenage stuff, No, I was always very entrepreneurial. I was, I was a very determined kid, and so I was in tech, and that kind of blew up. And then as default, I got in the insurance business. And
so tell me how that happened. So tech, as I understood it, you wanted to make more money. That was your original.
Yeah, that was money. Money was kind of my god back then. But then
there's a lot of people.
So but I wanted to be self-employed, and because I got really burnt, and with this, I had 5% ownership in a small company, and then went to another company. Got really burned about $60,000-$70,000 back then. This is big money back then.
Late 70s.
Early 80s. Okay, and I was pissed off. I didn't want to get burnt again, and so I said I'm going to work for myself. And my father always used to say, if you want to make money, work for yourself.
People that work are money at work.
Yeah, so that's how, and it was default as 82, 83. This is when interest rates 17, 18%. You couldn't get a job. So I got in the insurance business and with Prudential, and I was like rookie of the year.
Hold on, folks. Rookie of the year at Prudential. Just, came in and got rookie of the year. And wait till you hear what he did next, because he continues to stack and build parlay. He's a serial entrepreneur when no one's looking. Wait till you hear what he did next.
But that was hard. It was a horrible company to look at and work with back then. So, and I was living up in New Hampshire, and I moved back in to Massachusetts to be closer to my mom because she had had a stroke at that time.
And were you making good money?
I was making good. I was working. You know how it is in
Yeah.
the starting this business. I was working 70, 80 hours, 90
Yeah.
hours a week. I mean, just
Yeah.
just to get a toehold, and it was insane. And I was a workaholic. And but eventually I started learning pensions, and I actually had my first little pension business. I was working the New England Life at the time.
So wait, is this when you left Prue?
I left
You
Prue and I
started
went to work
in
in New-
'83. You started to work at New England with
New
for
England
the
Life,
pension
which
business.
was a very entrepreneurial company. It was like going from Kmart to Brooks Brothers.
Kmart to Brooks Brothers. I love that analogy.
So it was a really class company at the time. They no longer exist now because it's part of MetLife and whatever that.
Yeah, I did some business with them.
Yeah, so that had so that was kind of the beginning of the story, but
because it's important, because pensions, folks, we're going to get into why it's important to understand that retirement planning is about getting monthly retirement income. So you found the pension business now correct me if I'm wrong, from 83 to 89 before you sold it. This is when the 401k began to sneak up on everybody and take over, but you were still doing pensions. Can you talk a little bit about that?
Yeah, so it was a long story, but yeah, so I started doing them.
And take your time, because we're here for you.
Yeah, so I started figuring out. I had some really good mentors at the home office, and I started, like the kid taking apart the toys. I started figuring out how pensions worked. So I started doing pensions and profit sharing plans, and I had some good mentors. And New England Life was very entrepreneurial at the time, so I started doing a bunch of them, and within a couple of years, I was like one of the top pension guys there. But this is when I came to the conclusion, Rob, even when I was getting the money, is that there was so much red tape involved with pensions and retirement plans. I said, I'm not making any money doing these things. If the person was really wealthy, it was actually the worst place to put the money. It had a lot of money in retirement plan. And so I'm not making any money. And if people are really wealthy, it was the worst place for them to have money. So
Now,
who's making?
why was that? Why was it the worst place for the wealthy back then?
Well, because the tax rates. You remember the old success tax?
That's what I wanted to let them know about that.
Yeah, there was old success tax. If we had more than $750,000 in the account, there was success tax. So if you had, say, $2 million, the taxes would be as high as 50, almost 90% on. You have between the income tax and the estate tax and so forth. So I intuitively figured out that if people were really wealthy, it was the worst place to store money.
So, folks, every once in a while when I'll do a video, sometimes you guys get upset when I talk about the potential tax liability that you're looking at in some of these qualified plans later on in life. And by the way, just because your taxes are at a certain number today, it doesn't mean it's going to be that way. I think since the 1960, the tax law changed about 40 times. So it is a moving target. And, Barry had said to me recently that your IRA and 401k has a partner, and it's called, and you can't have a buy-sell agreement with it, and you can't have an operating agreement. It's called the U.S. government, and they get to decide exactly how much you're going to pay when you take it out.
Yeah, so
amazing. So you're doing the pensions.
So I'm doing the pensions, and then long story short, then I had one of my first life insurance claims. Unfortunately, I lost my brother at the time, which I was very close to, and
may he rest in peace.
Yeah,
I heard you speak about him.
We were very, very close to him, and so I had a good chunk of money, and so I had this other thing where I set up another business called
TPA.
Another third-party administrator, where I started doing flexible benefits to pick and choose. So I was kind of ahead of my time, I guess.
So everything you do, I was going to say that in my talk today, that you are like way ahead of the information curve on everything you did. But for the people that are like, just amateurs right now, what is a third-party, or TPA, a third-party administrator, and why are they important for folks to know what to have in their life?
Well, I figured out there was a section of the tax code, section 125, where if you did benefits pre-tax, you could essentially, it was a win-win for everybody, because so the employer would win because you would reduce his payroll costs, which was awesome. Because even today I understand with payroll taxes. So it was a win-win because you're reducing the payroll taxes for the employer. So there was a guaranteed savings there. You were also reducing taxes for the employee on their FICA component. They could get the first $50,000 group term life free, all health care spending, all the dental plans and all this stuff. And then the daycare, because daycare was getting really big and no one was really administering it. So I saw an opportunity, so I bought software and then I hired a partner, and it took us about 2 years to get it. And all of a sudden, I was starting to do work with public companies, and
just like that.
Well, it was
overnight success in 6 years, right?
Well, that was, it was like I told you about the time Tony Robbins one time.
I want to get into that in a little while. Let's talk about that.
But anyway,
because this journey is incredible. And listen, I've had such good fortune of speaking to you privately. I would love for these folks to get to know who you are.
Okay.
You know what I mean? And your journey, because entrepreneur's journey isn't an overnight success. And the amount of work you do and your passion, you're living your passion, right? So your passion is to educate everybody and to explain what's fair and how they should look at money and not be manipulated by the Wall Street casino. Period. End of story. Right? And your journey shows that.
Yeah, it's because what I saw, I never liked bullies, Rob.
Yep.
And I see no difference between Wall Street bullies. Okay, they're a bunch of bullies.
Yep.
And bullies in the schoolyard is to me no different than Wall Street.
Yep.
So I just hated people being taken advantage of. So
Yep.
that's kind of the whole thing. And I was just pissed off, and I even myself personally. So when I had all these pension plans, I actually selling that business. But
You did sell it.
yeah, I sold
Okay.
it. Yeah, so
And that's when you started the TPA business.
I started the TPA business, and then that took off. And then I had a partner when. It was really interesting. It was a tough. It was a lot of work. It was a tremendous amount of work, but I opened up a lot of doors.
So Barry, let me ask you a question. You said 3 great things there, but let me just focus on 2. There's no such thing as an overnight success. Barry spoke about how he worked really hard, and then, as a result, it opened up doors. So look about the stacking and the building. From 1982, Rookie of the Year, 1983 to 89, pension business, TPA business, opening doors. And my question to you, Barry, is do you enjoy the process more than the result? Do you get addicted to the process?
I like helping people. I mean, the money's just kind of like a
It's a byproduct.
It's
yeah.
a byproduct. I've had money and I've not had money, and I like having money, but it's not. You couldn't do what I do. It was just about the money. It's just, you couldn't get up and get excited about it.
But you do get excited about it, right? Like
yeah.
You have that burning desire to research.
Yeah, it's just I just don't like people getting bullied, and this is what they're being bullied now with, the markets and
we'll get into
cryptos and
Bitcoin
funds, Bitcoin.
Yeah, I call them kryptonites. Yeah, so
I call it financial sorcery.
Financial sorcery, financial fascism, target date communism funds, the whole thing. We'll get into all that.
Yeah.
So. All right, so now it's like, okay, the TPA business, and what happens next?
So I had the TPA business. I had a partner at the time. I sold it 1996. I started in 1990, sold it in 96.
Yep.
I think the business still exists somewhere. It's been bought and sold a couple of times since then. But so then I was getting involved with Bob. So
this is when things changed for you, right?
Yeah, when I got Leap and Bob Castellone, I got introduced to Bob Castellone, and he showed me, because I had a big benefits business too.
Yep.
During the time, so I was always a number guy. And when Bob Castellone showed me how the numbers, when he shows you how the 401k and the IRA was just kind of, it's a financial dream sheet. When I ever saw those numbers, because I was a benefits guy, I said, "Oh my God, what have I been doing?"
Because you didn't know.
I didn't know.
Yeah.
I didn't know, and I intuitively knew there was a ton of risk in this stuff. But Bob Castellone was actually showed me from a mathematical perspective how it couldn't work.
Yeah.
So all this dollar cost everything. It was just, I don't know, it's financial sorcery, if you will. But so which benefited Wall Street and the mutual fund companies and that type of thing.
So if I may, let me just kind of break down what you said for these folks so they understand that in bite-sized information, because you are coming with like heat and high energy and some of the greatest information. So Bob Castellone is the founder of Lifetime Economic Acceleration Process.
Leap, yeah.
Great mentor, Leap Systems, where he talked about all aspects of financial planning.
Yep.
He took a scientific approach with weights and measures, elements and components, looked at everything on the PSE&G model, right? And what Barry's talking about here is that if you looked at an IRA or 401k and you measured the pre-tax versus the compound, although Wall Street likes to say that, Einstein said that compounding is the 8th wonder of the world. Go ahead and call the Einstein Institution. You'll find out that he never said it. I mean, we could dispel that right away at this point. But what Castellone did so successfully is broke down when you take money out of an IRA and 401k after taxes, after fees, after inflation, because your money is compounding not on the outside but on the inside as well. It's no better than a 30-year bond, right? Like that's some of the math where he's coming from.
Yeah, and that's the whole thing too. And actually, I have some research will be coming out in the next book. So people, if they want to get on my website.
BarryJamesDyke.com. Yes.
So, but the fact of the matter, large asset managers, and I have two actuarial firms to back me up on this. They measured the rates of return on large pools of money, roughly $4 trillion, and they found that that most of these plans they get really not much better than a 30-year Treasury bill. So if they trace it back from like 2000 to 2019 or 18, Cliffwater and Piscataqua Research, Cliffwater, who's out of Marine Del Rey in Manhattan, and then Piscataqua Researchers up where I live in Portsmouth, New Hampshire, two really world-renowned actuarial firms. They discovered that the people's rates of return over 20-year period were really not much better than 30-year Treasury bills. So people, all this gambling and all this stuff, they would have been better off just putting their money in Treasury bills.
Unnecessary risk, right? Yeah. Emotional turbulence, divorces, like bad, everything leads to
so this is the whole thing. And these are, we're talking serious. I mean, these guys, their numbers are right on, spot on. But getting this in the media, all the business people, they want you to gamble, and gamble more.
Yeah.
And so Bob Castellano showed me from a mathematical perspective.
Now, did actually? So that was a shift in your career, though, right? Like, what happened next? So now, you.
So I started reading about. Then someone told me about the book, "The Creature from Jekyll Island," about the Federal Reserve. And then when I understood how banks, how the Federal Reserve was not federal, there were no reserves. And
so what does that mean? Like, we're 2 years old. So for these folks right here,
for the folks, well, the whole thing is it's the Federal Reserve. Everyone thinks it's part of the federal government. I certainly did for years, but the truth of the matter is that. It's not federal. There are no reserves, and it's got as much in common with the federal government as Federal Express does. It's a private central bank, and so when I figured out that the Fed was a private central bank, my whole when I started understanding banking, that's when all my research, like aha moment.
And this was in 98, 99, and 2000?
Yeah. Well, I was going through a tough time at the time. I was going through a separation divorce, a very tough divorce, and so at the time, I was reading things from all different sources. So by reading, there was a guy by the name William Greider did a book, and then Griffith's book of The Creature from Jekyll Island. I read a lot of other books. I started figuring out, and when I started figuring out banking, then I started really figuring out how mutual funds work and how insurance companies work, and how banks are very highly unstable because they're so leveraged. And now they're even more worse than ever before. Actually, since September 2019.
So there's no more reserve requirements. Is that what you mean when you say that?
Yeah, well, because the repos, they essentially market froze up in September 2019. So if you have how it works. Like if you have $10,000 in a bank, how much they can leverage?
100. Yep.
Well, actually, they could legally do about 9 times, but during the financial crisis, they're all levered 30, 40 times.
Got it.
And I have that in the book.
This is in the 07 book. Pirates of Manhattan?
Well, actually, I came out with that when I came up Pirates of Manhattan, too. I went through the leverage, how Deutsche Bank and
Got it.
And Morgan Stanley and all these banks were levered 30, 40 to 1.
Got it.
So, but since 2019, when the repo market froze up, essentially banks really are operating with really no reserves.
Wow. And the insurance companies have to have a requirement to measure every dollar.
Yeah, so if that's the whole thing. So if you figure I put $1 in an insurance company, it has to be 100% reserved.
Yeah.
Whereas if I put a dollar into a bank, they're using it, 100 times, 50 times, 20 times.
And there's no accountability.
There's no accountability. So when I figured that out, I said, oh my goodness, actually insurance companies are a lot more responsible than the banks, and they're the ones who got all bailed out during this financial crisis.
Yeah.
And actually the GAO figures speak up for themselves between Citigroup, Morgan Stanley, Merrill Lynch, and
Fargo.
Bank of America. They get $7 trillion in free money from the Fed.
And what year was this?
2009, 2010.
Wow.
It's all government statistics, So I'm not.
You're not making it. Yeah.
I'm not making it.
So in 2001, 2, 3, let's say, and I know the NASDAQ. I heard you spoke about how 75% of the companies, on the NASDAQ that were there in 1999 are now gone, either because they went out of business or they were taken over. And that's like, people don't understand that. Like, there was a lot of money put into those things in mutual funds, and I think because, we have a new wave of generation of people, they just don't understand, how risky their money is.
Yeah, 85 cents in every dollar in mutual funds were going to high-tech stocks in 99.
Like, that's crazy.
85 cents. And actually, I didn't dig this up. It was The Economist, actually a pretty good magazine people want to read. It's daily magazine.
What's it called?
The Economist.
The Economist is a good magazine, folks.
Yeah, people
check it
read out there. Read some books. Don't just listen. I know we're going to be on the social media, but read books. That's where you get really good, solid knowledge. But yeah, 75% of the stocks that were listed in 99, 2000 no longer exist on the NASDAQ.
Amazing.
So now it's actually worse than, it's 1999, 2000 all over again. We look at the SPACs and that.
Right now?
Yeah.
Yeah. So let me ask you, so now 1, 2, 3, you're starting, I guess, research for your book that eventually came out in 07.
Yeah.
And you did open up your own RIA, once
Yeah,
again,
yeah,
ahead of the information curve like everybody else.
Yeah, yeah.
I mean,
full disclosure, I had my ADV, I have to disclose everyone.
Yep. And we're not making any recommendations, folks. We're just having a nice
Yeah.
interview here about the world as it is.
Yeah, so
according to Barry.
So I have to be full disclosure. I am a registered investment advisor. I do
Yep.
do work with people around the country.
Yep.
But yeah, so and everything's disclosed. So I'm an open book. But so when you figured out that these stocks come and go and it's a bubble, and when you look at, as Mark Twain says, history doesn't repeat itself, but it rhymes. And I was like, oh my God, the blind pools during the 1920s. It's the same thing as these SPACs.
Yeah,
and
just a different name.
And who was the last person to use these?
Retail.
These SPACs, if you will. It was Michael Milken.
Oh.
With Executive Life.
Yes.
And the Columbia Savings and Loan, which ended up being blowing up in 90, 91. Okay.
So can I share that with these folks? So Executive Life was a life insurance company that was run like a stock company, I guess, for all intents and purposes. It eventually went out of business, but all the people that owned insurance, they got their money back.
Yeah, but that's.
But Leon Black then took the money and went to Apollo.
The irony of the whole thing. It was actually, it was totally illegal at the time. It was actually Leon Black from Apollo Global Management. He actually negotiated. He actually had a private equity firm at the time called Lion Capital, which is now today Apollo Global Management. Which is the one of the largest private equity firms in the world.
The devil.
Okay, Jeffrey Epstein's
devil,
buddy.
I'll say it, the devil.
So
evil.
So, but it was totally illegal at the time when they did this, the takeover. And Leon Black went to Credit Lyonnais, French banks, which purchased the block of the junk bonds, about $9 billion block of junk bonds for like $3 billion. And they parlayed it and sold it, and I think Leon Black, Apollo Gold, made about $1 billion, and Credit Lyonnais made $3 billion. Totally illegal. It wasn't until 1998. Now they collapsed in 91 or 90. Okay, the state of California took them over because they went to insolvency, and it wasn't until 1998, and there was an investigation. A whistleblower. I think he's still unnamed to this day. A whistleblower, and he said what a scam this was. Now this is the whole thing. This is totally illegal.
Yeah.
What they did, and they sold it was against the law in California. It was against federal law because Glass-Steagall was still in fact. A
lot of information here, folks. Glass-Steagall Act, 1991, Apollo Capital Management, Leon Black. Look it all up.
So Glass-Steagall had them repealed. So it was totally illegal to do. But anyway, so they sold it to another Aurora National, which is out of and ended up being part of Sun America, and then Sun America became part of AIG and the whole thing. So the irony of the whole thing is that he made $1 billion, and this was the seed capital for private equity.
But in '98, you were saying
98. So, but because Leon Black was Michael Milken's right hand man, and the irony is that Milken was theoretically banned for life from the securities business, but he's been working, and he's still a billionaire today.
Scenes.
Yeah. So it's just
Yeah, amazing. So so all of a sudden now, once you learned the math from Bob, you're now learning stuff about what you were just sharing about from 91 to 98. You decided to open up your own RIA, and I suspect it was in an effort to make sure that you were there to steady the course for your client, the people that are going to do business with you, to make sure that they were taken care of properly.
Yeah, well, that too. I wanted to make a living too, and I figured all these guys now were making all this money. I knew friends of mine had been in the business, were making a lot of money at assets under management. That model, and also I was doing a lot of research. I wanted to get paid. I wanted to be held. I wanted to be independent, and so I did it kind of I had to survive at the time. I had to reinvent myself because I sold my the administrator to my partner at the time, so I had gotten rid of that. And I had moved to a new house up in New Hampshire, and it was a lot of it was just But in any event, so I get involved with the IRA, and then I just went. then I had to kind of reinvent myself. I went through a tough divorce. I had to figure out how to make money. And so I said, what do I know? And I said, well, gee whiz, some of the stuff that works, and some of the only stuff that really works was life insurance and annuities. And then I think it was a God moment, and I believe to this day is that, because this is the time you had to pay $5, you had to use a MasterCard if you wanted to get an online article. And so I started getting articles from $5 when I had no money from the Wall Street Journal. But I started researching that the banks.
What made you do that, though? I want to get into that, because this is where everything changed.
I heard that banks bought a lot of life insurance and things like that. And
you heard it.
I heard it, but no one. But I called the insurance. I called the insurance company. I called some of the brokers that did it, and no one would talk to me. So and then so I was just being the old curious kid I was. So I just started looking at it, in deep, and so then so I called the insurance company at the time. So the big players, the Masses, the Northwesterns, and all that stuff. They were really big. New York Lives were really big in this stuff.
Four Horsemen.
Yeah, and they wouldn't talk to me. So
really,
but in any event, so I started reading about the. But I figured out that on the Federal Deposit Insurance Corporation, which is
FDIC,
which bails out, which if you and all the taxpayers are behind, they had to disclose balance sheets on it, and so I really didn't have anything. But then I became friends with this black lady down there, and she was really kind to me, and I figured out. Well, she didn't figure it out, but she showed me how to download the stuff, and I said, "Holy mother of God!"
So wait, hold on. Let me just stop right. So at this point, what year? 2003 or 4, 5?
This is around 2005.
Nobody knew the amount of money that banks were putting into life insurance. Nobody, and you couldn't just get the information until. Barry kept digging and kept digging and kept digging. He had a hunch. Intuitiveness was in his favor. He went with it, and then all of a sudden...
And then this woman, and she was really nice. I forget what her name was. I'd send her flowers and candy down the whole thing.
Brilliant.
I didn't have any money, okay. So she showed me how to download it. I was like, I hit the jackpot.
You knew right then and there. You knew something no one else knew.
I knew someone else.
You discovered something.
I said, I can't believe this. So I see these banks like Citigroup and
wow,
and J.P. Morgan and all these major banks, Bank of America, Wells Fargo, all these companies, Wachovia Bank and the whole thing. Like Wachovia Bank, which ended up, it was 35% of their net asset value was invested in life insurance at the time.
Wow.
This is all verifiable.
Wow.
But so
you saw this.
So I saw this, so how do I package it? And luckily I had a really good friend of mine.
So you knew you wanted to write a book, though, is that correct?
Yeah, I always wanted. I always had it, but it was a lot of work. But in any event, and I tried putting this information together and tried to get a publisher and the whole thing. Everyone turned me down.
Really? What was the reasoning? Just so.
Oh, they said I'd never make it. Everyone said no, you'll never make it. You'll never be a success.
Best-selling author, 30,000 copies sold in 23 countries. Folks, just take a note, write that down, take it, rewind it back. He sold 30,000 copies of the book Pirates of Manhattan in 23 countries, and they told him it wouldn't work. Thank you.
Yeah. So anyways, but luckily I had a really good friend, Dave Michael, whatever. He's still helping me to this day, and he said, "Look, I'll help you do it." I had no money because I was under divorce. I had really no money, so we decided to self-publish it, and I set up a publishing company, and I packaged it all together. And then I just stumbled into this, and I couldn't believe this. I started looking at you could really get a lot of information on the internet because now there are a lot of blockers and stuff on it. But I said, holy mother of God, I found out that actually the Federal Reserve itself actually classified life insurance as an asset, and it was one of the most safest assets of the bank. So other than gold or cash or treasury bills, they considered life insurance a very, very safe asset. And all the other stuff was crap. Matter of fact, banks to this day can't put their reserves in equity because it's so volatile. So I discovered that. So then I put all the stuff together, the book. And
how long did it take you to do the book? Like from when you first started writing it to publish to when the first copy was sold?
A couple of years.
Wow. And you were committed, like, was it every day you would just add into the book?
Yeah. I would, and at the time I was separated, and so.
Did you know you had something special?
I knew I had something when I discovered how much the banks had. I knew I was onto something.
Yeah.
But then I also discovered is that even if but telling the truth is not that easy in this country because.
Did you know that though?
I thought it would be. I thought I would be accepted by saying, "Hey, look what I discovered." But it was actually,
no one invited you to the party, right?
No, and it was actually the exact opposite. Actually,
they made sure you couldn't come to the party.
So the main media stuff like that, they never, to this day, they really haven't acknowledged it. But then I had the guys like Bob Castellone,
So he brought you into Guardian?
Well, no, I wasn't with any of it.
With the book.
But the book was Warehouse at Guardian at one point, and then Mass Mutual, and then.
So explain what that means. The book was warehoused at Guardian.
Well, actually, anything, the compliance is so tough. They have to go through everything with a fine-tooth comb. So, and as I remember, this is the time. They're buying like 3,000 copies of the book.
So you started seeing revenues now. Now it was
yeah.
real.
So I was actually making money, and then I got speaking gigs talking on that. So my life had changed. Now you got to understand. I'm working. I'm doing this out of a 2-bedroom apartment on the beach. Okay,
Wow.
selling this.
And you're still like having clients though, right? You're still running your RIA.
But anyhow, so that the book started selling like crazy, and then I started doing speaking gigs and
Wow.
And it was fun.
Is this 07, 06, 07?
Yeah, 09, 08, 09. Yeah.
So the market already crashed at this point.
Yeah, and so everyone it looked like I was a genius, but anyway, it's probably the only place the banks didn't lose money in 07 and 08.
Yeah.
But
So if anyone's watching us right now, right? Well, let's just go, BarryJamesDyke.com. But remember, if you're on my channel, I will give you the book for free. Book an appointment. With that being said, though, if you could kind of talk in 2-3 minutes, what is the book about? What is the book? We know that it's going to show that the banks own a lot of life insurance, but what is it about?
It's about showing people a safe place to put their money with maximum economic benefits, and and when you realize that whole life, particularly, is an economic workhorse, and you understand how much you can really do. Everyone should know this stuff. And actually, as a matter of fact, in 1905, Rob, is a true fact that 50 cents in every savings dollar in the United States was going into life insurance and annuity products
For pensions.
Yeah, for pensions and what have you, because they didn't trust Wall Street back then. Okay.
Yeah.
Now, but roughly, I don't know, savings dollar now maybe 6-7% on the dollar.
How much?
Only about 6 or 7% of the flow.
Wow.
Good. So it should be. And actually, if you study other world economies, in Netherlands, other systems, Singapore, whatever, most people really want to have money in a safe place. We're kind of a crazy place for gambling.
When it comes to retirement planning, I heard
yeah.
you mention-
Well, the Germans put 85% of their money into safe stuff. They don't trust. They consider mutual funds and stocks as gambling. Okay?
Yeah.
So I'm a capitalist. I'm a big believer in the market, but I just didn't want to. So people need to have a foundation. Okay, like you have a house, you need to have a foundation.
Yeah.
Okay, but now with the market now, if you're building your foundation on cryptos or ETFs or SPACs or whatever, it's very, very shaky.
And to what your point is, Barry, that people own SPACs and they don't realize it because their mutual fund just bought 15% of it.
Yeah.
So they don't even realize what their mutual funds are purchasing.
No, they don't. And people, I'm calling them communist funds because it's a kind of blind obedience. And it's
Blind obedience.
Yeah,
Oh my
because
God.
well, in the old days
This is some incredible language. Go ahead.
Because in the old days when the companies would go public, brokers, they'd have regional networks and they have thousands of brokers peddling the stock.
Yeah.
Now it's really easy for them. They can go to Vanguard, State Street, Fidelity,
Yeah.
Invesco, what have you, and it's really easy for them. So, and all these companies really get their money from retail investors who have no idea what's going on.
Wow, incredible. So a lot of folks, when I'll do like little videos on TikTok and Instagram, 60-second clips, and they'll ask questions. How does the bank make money with life insurance while at the same time they're loaning it out for student loans, credit cards, and mortgages? How does that operate? If you could break that operation down.
Well, let's just say a bank has got, say, $10 billion in cash surrender value, which is very reasonable for someone like Wells Fargo, Bank of America.
And you're talking about $10 billion in life insurance.
Yeah, actually, I think
Contracts.
Bank of America is like $22 billion. That's just surrender cash value.
Yeah.
Now the death benefit is about 6 times that, so maybe $120 billion. All right.
Got it. And that's on all the corporate executives?
Was the top 35% of the population. Okay, they used to insure the entire population, but they have put some reforms, and so they're only insuring the top 35%. So when they're using it as insurable interest to fund future benefit plans, that's what they're saying. But why do they do this? Why does anyone put $10 billion in annuities or life insurance? Well, first of all, there's a guaranteed rate of return,
Yep.
4% on these contracts. There's also additional dividend of 1 to 2%, even in a really down period of time.
Yep.
You're getting professional money management from the life companies have portfolio managers just like everyone else. The money's growing tax deferred. as the cash value increases, it flows to their income statement. So it may give them a penny or two onto their income statement, which is a big deal for these executives. They know everyone's going to die, so when the insurance does mature, when people die, the money comes into the bank, income tax free, just like anyone else.
Yep.
And then they also they'll snap off a piece of it. They'll take a piece of the life insurance and they'll convert it into annuity. And the executive is ecstatic because he knows he gets a guaranteed income for life.
Yeah.
And so and I actually put this in the in the prior book. So
does the bank use the money though to borrow to lend?
Well,
out?
that's the other thing too. Listen to this. Yeah. So not only they have $10 billion, okay.
Yeah.
Because it's.
Did they take like $1 billion of it and lend it out to all of us?
Well, yeah. Well, it gets even better. So they have like say $10 billion. Let's say so people understand. So they have that $10 billion. Okay, it's in their tier 1 capital.
Yes.
Which is the most important part of the bank.
Yep.
So that bank not only has that money very, very safe place, but they can also, because it's an asset tier 1 capital, they can also leverage that bank own life insurance.
10 to 1.
So 10 to 1.
Wow.
Now it's unlimited now.
Wow.
So when I started figuring this out, it's like everyone needs to know it, but the only place you really get to hear it is people like you or some other people,
So you wrote the book. You're on stage. The market crashes. Who are some of the forces that are coming after you after that?
I had the IRA.
Without talking about too much.
Well, yeah. Well, it was really weird. I immediately got audited. My registered investment advisor. I actually spoke for the Washington D.C. police captains one time. They said, yeah. They said they look at you, whatever. So it's just it's been quite the journey. My faith's very, very, really important to me. So so people don't like it. But then I was it's been so I was immediately audited and the whole thing. But luckily, I take all my compliance very seriously.
Yeah.
And as I said, my books were warehousing guardian, and all the lawyers went through it with a fine-tooth comb, and so I was actually able to warehouse the book.
Yeah, yeah.
So it's just truth is we live in we have so much to be grateful for to live in this country we do, but so much of the information, financial information, it's pure propaganda.
So when we're experiencing like this year, the market's obviously going through a correction. Do you get more calls in these times based on your book? Do people come back to you and start?
It's funny, it's like Jesus wasn't a hit in his hometown either, and so
Jesus was not a hit in his hometown. I love it.
But I have clients like in Wisconsin and all over the place, California, things like that. People outside of me, so people come, they find me, and it's like, and so so it's just, but I'm trying to change that now. I'm doing more information seminars and stuff like that around where I live.
Awesome. And when it looks, Pirates 2 came out, and then you came out with Guaranteed Income.
Yeah, Pirates.
You want to talk about the sequence of those books?
Yeah. So I came out when I discovered that they came out with the target date funds now. By the way, and all
target date. Write it down. Everybody got a 401k. Write this down.
Because
you're gonna learn something.
That's where 80% of your money is going right now, whether you like it or not. And,
communism funds.
And so essentially, it was put in part. By the Pension Protection Act of 2006.
PPG.
The Pension Protection Act, which actually was another airline bailout bill, but it actually, where they created what's called the QDIA, Qualified Default Investment Account. So this is where the mutual fund companies actually lobbied to get mutual funds put into as a default investment for 401ks, because there was a real problem with where do you put the savings. And so by 2006, but now they've grown to probably 80 cents on every dollar now is going to target date funds, which no one knows what they're going to do.
Wow.
And then I started analyzing it, and I said, oh, my God, what are these things? I started analyzing these things, and I took like a week or two one time to try to analyze some like target date funds for Fidelity. I said, my God, I can't figure this out. If I can't figure this out, I'm an RIA, and I'm pretty anal. Yeah. How's an investor or a saver going to figure it out?
Yeah.
But in any event, because through legislative fiat, as long as the employer chose the target date fund, they're not going to get sued. So it's all about lawyers,
What does legislative fiat mean? So these folks.
So legislative fiat, essentially they pushed target date funds as a default investment.
Got it.
So the employer couldn't get sued, the asset manager couldn't get sued.
Got it.
But what about but there was nothing really for the saver, the investor, and that's a big problem.
And the 401k, the employee takes on all the risk, not the employer.
Exactly, and this is the whole thing. And this
Ted Benner.
Yeah, Ted Benner, and actually Ted Benner, and people go to the boomermovie.com.
We'll talk. Yeah, we can't wait to talk about your movie. A movie just came out, by the way.
So anyway, so this all came out of the qualified default investment account. So people were forced into the market.
Yes.
And now they're putting in auto enrollment and escalating stuff. So it's really it's guaranteed income stream into Wall Street and the mutual funds and so on.
So interest rates go low, money's printed, then people have to take their money and put it into the market, these 401ks, which goes into these target funds, which no one knows what's inside these target funds, like from a full transparency standpoint at least. And by the way, there's no accountability. And Wall Street wins.
Yeah, Wall Street wins, so it's a guaranteed source of capital for them.
And then Wall Street pays the advertisers to put all their commercials on TV. So if you look at CNBC, they're not making money because of the market. They're
making it
money
on advertising.
On advertising.
Yeah, they really don't know. And that's the whole thing is that because then I think I told you then I was actually referred to CNBC and.
No, tell me this part. This is good. It's going to be good. I can tell by his laughing.
I was referred to. Let me say a very influential person who opened the door for me at CNBC,
Yep.
and I sent him a copy of my books, and they laughed at me.
Mm.
Said you're crazy, because I had the picture of Alan Greenspan on the cover, and come to find out, but this is at the time when CNBC was owned by actually GE at the time. This is before they sold it to Comcast.
This is before 2007?
Yeah, no, actually, because GE didn't sell Comcast, didn't buy NBC till like. 2012.
So this was a way of trying to dispel your work.
Yeah. So I said all this, and they laughed at me but I was really kind of, I was very very upset because I understood Jack Welch. They're spending like $1 million a year in his life insurance premiums alone.
Yeah.
I understood that GE was actually the largest user of life insurance, corporate-owned life insurance back in the 50s. So I knew that they were. But they laughed at me.
Yeah.
And so
bullies,
and then I had the same experience with the National Public Radio and then Bloomberg and so forth.
Yeah.
So I give them all this research, and I was essentially laughed at, and it was the old New Yorker guy said, A.J. Liebling said, the freedom of the press belongs to the man who owns a press.
That's right.
And I didn't own a press.
Yeah. And that's why Dave Ramsey, he's on the run right now, but I know that Barry, with a neutral set of facts anywhere, anytime, is ready for you. So just to go over exactly why whole life is part of the perpetual way of creating that generational wealth while at the same time enjoying the life that you deserve.
Yeah, so that's the whole thing. So when then just all this misinformation, like Dave Ramsey saying he would tell people getting 12% compound. I knew the statistics. So the long range investment returns pretty much mirrored 30-year Treasury bills. So it was just really misinformation. But Dave Ramsey's made a fortune with the Christian church using
good marketing.
It's
bad advice.
Brilliant marketing, and I agree with him about the debt, but I don't agree about the markets.
Yes.
But he actually, Princeton say people get 12%, but the whole thing, he's just a lead provider, and but there's no if everyone could get 12% compound, we wouldn't need any financial planning or anything, but it doesn't happen. You
know what, Barry, you bring up a great point. I want you to help me with this. This is for me. If you look at the greatest chart ever, marketing scheme, they'll go the S&P from 1980 to 2021, and they'll show you that if you kept your money in there, reinvested the dividends, that you would average 12.4%. At the same time, intra-year it averages a decline of 14%, and then 35 of the 41 years it ends up. Now, for all those folks that hear and see that, they're not showing you the 1099 that you're paying on taxes, right? They're not showing you if you have to take money out for college. They're not showing you if you have to take money out because life happens.
Yeah.
They're just selling it as a 12% average rate of return. How do you tell folks like that what they really need to understand about the science and the emotion of money?
Well, first of all, it's like sailing. I'm making anywhere in the summertime now. Sailing, you can't sail straight into the wind or whatever. It's a zigzag course. Life is a zigzag course. We get knocked off of it. And so the institutions love to show us these mountain charts, like Bob Castellano shows these mountain charts.
Yeah.
But they always show us the mountain charts and mountain rates of return, but they never show us the mountain costs. And then we don't know whether we die or become disabled,
Yep.
or
Lose
you
your
know,
job.
we or lose your job or something. So we don't know the future. I mean,
Yeah.
I don't know what I'm having for lunch today. Never mind what's going to happen next week or 10 years from now.
Yeah.
So the whole idea is that we know the future. We don't know.
Yeah. Yeah.
We just don't know. But Wall Street is, with target date funds and what have you, with private equity now, they're saying that they can predict the future when they really can't.
No, talk a little bit about how they're saying with private equity they can predict the future. What is their pitch and what is the truth?
Well, the thing is that that's the hottest thing. Alternative, they call them alts.
Yeah.
Alts.
So the people should be aware of what you're saying right
alternative investment. They're the new hot thing now, which are essentially private equity, hedge funds, distressed debt, commodities, things like that. Alternative investments. Okay, so you can get more of a premium or a yield from these things. Now you could, okay, but all the research, which, but the I think but they're being pitched as a new alternative.
But the odds on a unicorn happening.
Yeah, but we don't. Again, I mean, you look at all these unicorns. These unicorns are turning into unicorpses.
Yeah.
You know. So this is what we're seeing now. But people are being forced into this stuff. So it's actually the Department of Labor approved the stuff in June of 2020. And the SEC, I think, approved this stuff as of September of last year. So now you got companies like Vanguard, BlackRock, Fidelity, all these companies now pushing these alternative as something new.
Yeah.
You know, but again, it's the same old wine, new bottle. Okay.
And these are inside 401ks?
Inside 401ks. And actually, they can put up to 15% into the target date funds, which control most of the money out. So if you think your 401k is a black box now, it's going to be even worse with these alternative investments.
And when people find out, it's going to be too late.
Yeah.
Because the alts didn't work.
Yeah.
The way they thought it was going to work.
Yeah. So there's a lot of great research done by Eileen Applebaum. Google her, and Rosemary Blatt, or another economist, Ludovic, a fellow who out of Oxford University. People I've interviewed. It's just, but this is where all the billionaire money goes. So and when you start looking the connection between private equity and our politicians, for instance, like, you know, Joe Biden spent last Thanksgiving at David Rubenstein's house on Nantucket and it's a matter of public fact. Don't believe me? Google it.
Yeah.
Joe Biden.
I remember.
You know, David Rubenstein. You know, and he's one of the private equity oligarchs who also has his own TV show on Bloomberg.
Drives traffic.
Yeah.
Right. So once again, Barry James Dyke, DYKE.com. Check him out. Also, he's the Economic Warrior. Phenomenal podcast. The information that you're being given today is world class. I promise you. Dot every I, cross every T, double check everything that's being said, and you will see that, you know, Barry, who did sell 30,000 copies of the Pirates of Manhattan, at the end of the day, 23 different countries, told the truth about Wall Street. They then brought him on to try to make fun of him. He then came out with the Pirates 2, as well as Guaranteed Income, and another book's coming out in the next 6 months. Also was in a movie. You want to talk about the movie?
Yeah, there's a movie. People go to boomermovie.com.
What is it? Boomermovie.com.
The baby boomer dilemma. Because one of the toughest problems in economics, Rob, is how do you take a lump sum of money? You have a $500,000, million, or a couple $100,000. How do you create an income stream? Because in retirement, the big problem is really how do you create an income stream? Because that's what people want. They want a Social Security or a pension, whatever. So that's the big problem. So, some
the Boomer's Dilemma.
The baby boomer dilemma. You go to boomermovie.com. There's a clip, and
you're in it.
I'm in it. Yeah, I'm in it for like 50 seconds. But some of the top economists and friends of mine, Ted Benner's in it.
Yep.
The guy who created the 401k, and Ted Siddell, who's one of the largest whistleblowers of all time.
I saw the interview with Ted Siddell.
Ted Siddell, Ted's a good guy. He really.
You want to? We'll get into the movie, but you want to share, you know, what Ted did actually?
Yeah,
I thought was pretty incredible.
Yeah, he actually sued J.P. Morgan. He got a $78 million settlement, whatever, and he's an attorney, and he used to work in compliance, and he's a forensic attorney, and but anyway, he just shows you how Wall Street likes to separate the masses from the money.
Yeah, separate the masses from the money, folks.
And then Dave Walker, who's a friend of mine, he did the forward of my last book.
Yep.
And then you had David Babel, who was at and Olivia Mitchell from Wharton, and they both have they were probably two foremost economists in retirement planning in the world. And then we had two Nobel Prize winners, Robert Merton and William Sharp.
Sharp ratio?
Yeah, Sharp, the one and the same. Yeah, who was in the movie as well.
Incredible.
About how using
it's the Godfathers of money right here.
Yeah, so it's many of us. They're all in the movie, and they put me into they brought me into because I was the research guy who said, by the way, this is where the banks put their money.
Yeah.
Or even like someone like Elizabeth Warren, who
Pocahontas
says Pocahontas has got about $4 million in annuities.
Does she really?
Yeah. The irony of the whole thing, in 2015, she did an investigation saying insurance agents are really bad. So, but
did she really?
Yeah, but if you go on to if you go her disclosure when she was running for president, they have to disclose the balance sheet.
Yeah.
And it was clear as day. Yeah, between her and her husband, they have about $4 million in annuities.
Wow.
With Kraft. Yeah.
Huh.
So she said annuities are really bad, but her and her husband had $4 million themselves.
Interesting.
Yeah.
Interesting. So, with the movie though, they brought you in because you're the research guy, and to talk about like cash value in annuities or life insurance and annuities. What was the outcome of that? Like, what was the whole other side of when that movie came out?
Well, it was based upon a true story about a couple that went away in 2007. They lost most of their money, so it was really about how do you create an income stream, because Vanguard, none of these mutual funds, they don't know how to manage it. And when you look at the end of the day, is that they brought me and my research in because I discovered that a lot of your major companies, like your banks.
Yeah.
And you're like Hewlett Packard, we mentioned, or how General Motors, spent $29 billion in annuities. So the reason I was brought into the movie was because of the research I had done.
Now, when did I know Hewlett Packard spent $5 billion. When did what year was it when you said that GE did it? Was it the 50s?
GE actually, and that's the irony of the whole thing. GE actually bought a $1.7 billion, I believe, in 2021.
Annuities.
Yeah, General Electric, and
for their employees.
Yeah. And but the landmark one was in 2012 when General Motors spent $29 billion.
So can I ask you a question? Like, if they're now doing this, is this a way of trying to? Because if all of these companies had 401ks where they wanted to give the risk to their employees, but now they're buying these annuities, is it because they care about their employees, or they're trying to protect themselves from a scrutiny, or? Like, what is the motive behind this?
They're doing it for the latter, primarily because they have a pension is an obligation, whether it be collective bargaining through a union or for some other thing. So they're doing it essentially to what is called de-risking. So essentially, they're saying, hey, look at General Motors. Like, we build cars. We're not in the business of running pension plans.
Yes.
Okay.
Yes.
Or a manufacturer like Bristol Myers Squibb or Verizon. We're in the business of phone service. We're not in the business of running pension plans. They're saying, we can't manage this. And if you study history in it all, you find that life insurance are the companies that are the best manage these the pension plans.
Yeah.
Because actually, whole life was actually the original form of how pensions were created. But so they're doing it for business purposes. They're getting rid of the pension benefit guarantee premiums they have to pay. They're getting risk off their balance sheet. And so the executives can make a lot more money for themselves as well. So they're doing it to get rid of the risk, to de-risk is what it's called, but it's also they're meeting all their obligations.
Now, is this because they're allowed? Is there allowed to be an arbitration if people are upset, or is it that they really care about their?
No,
this is important. I want everyone to understand motives, intentions, and.
No, well, they have a pension. Like if it's a union or something, they have a contractual guarantee.
So in these, but in these, if you look at the police, like here in New Jersey, state and local pensions, are they at risk? Versus these private pensions that you're talking about?
As you know, the government pension plans are all a mess.
Yes. Can you delineate the difference for these folks? Versus like a whole life, like an insurance carrier.
All right. So you have to. There's a body of law called ERISA.
Yep.
In 1974, which was essentially that's the whole governing body of law for pension plans. And this, if I'm running a pension plan with IBM or Coca-Cola or who Bristol Myers Squibb or J&J or here or whatever, they have to have certain funding ratios and everything, so they have to be financially solvent.
They're scrutinized.
Yeah, they're very scrutinized, okay? So if I'm running a corporate pension plan, I'm very, very scrutinized. However, if I'm a government entity, I'm exempt from ERISA.
Wow.
So I don't have to do what all the corporations do.
Sounds like the banks.
So there's no I mean, they have guidelines that they have actuarial equivalents and all the things, which
But they're
But
not subjected to ERISA. You said it all right there.
yeah. So and they don't have to pay any premiums and the whole thing, so they can just do what they want to do. So some of your pension plans, like in Jersey here or in Illinois, they're only 30% funding. I mean, if you're below 80% funding in a corporate level, they look to shut you down.
Yeah, yeah.
But because government plans are exempt from ERISA, it's a much bigger problem.
So Barry, what I hear, and I'm going to just kind of give a simple, everything you're saying is unbelievable, but to simplify it, you stand for the everyday person to create their own private pension strategy to be complemented with Social Security.
Yeah.
So at the end of the day, when they're in retirement, there is a guaranteed stream of income.
Yeah.
No different than Sweden, who I think is number one when it comes to retirement planning, versus America, which is number 18 or 19. Is that correct?
Yeah. We're real pikers in the grand scheme of things. There's actually Mercer Pension Index. They do it once a year. And
their assumptions are low.
So this will be in the book, but Iceland is number one.
Oh, it is?
Iceland, the Netherlands, Sweden, the Scandinavian.
Oh, so I got it. Okay, I apologize. So
no,
Iceland is number one. Yeah.
But we're kind of an also-ran. I think we're at the top 20. We're like number 19. So we really have a crappy retirement system.
And I don't think people understand that. That's interesting. So, we talked about Pirates 1 and 2. We talked about guaranteed income. Is there anything that I'm missing so far based on the journey that you'd love to share with the group?
No, it's just, people, you have to do your research. Don't take, read my books. Don't take my word for it, okay? You do the research yourself. I've already done it for you. And it will help you immensely. People need an advisor, and, you don't want to call up some, way these institutions want to do it, they want you to call into some call center and have some 26-year-old, all due respect for 26-year-olds, to answer all your questions, okay? But it takes
There's
years.
no algorithm for experience. I think you said that.
And it's just like, how do you do this? And so there really, it's kind of like going to, I don't know, they want to have like a robo advisors or whatever, but
yeah.
You have that you need to have love and caring for people really to do the best job for them.
So Barry, let me ask you a question. I'm not confused at what your mission's been. When it's all said and done, and your life's work is complete, whenever that happens, what do you want to know, or what do you want to be known for on the impact that you've had on the world?
It's a great question. Hopefully when I graduate from this life, I'll say, well done, my good and faithful servant. I think it's just trying to put light on and helping people, My father always told me that when you find something, you always try to leave it better than the way you found it. And maybe that's, I'm just trying to find it a little bit better.
Yeah, amazing. I want to thank you so much for coming in today. Super grateful to be, spending some time with you like this. To me, you're one of my living legends. Very instrumental when I first started in the business. And, for all you folks that are out there, you want to go to Barry James Dyke, DYKE.com. He has 3 different books. Like I mentioned that if anyone wants a free copy of the book, which we will supply once you sit down and do a full financial free audit, no obligation, of course. The Economic Warrior is also his podcast. If you look at the guests on his show, you're talking about the who's who, some of the most greatest information that you can get your hands on. I would take this and I'd go back to the beginning, grab a pen and piece of paper, write down, ask questions in the comments below. If you have any questions, ask questions. If there's other videos you'd like to hear or see, let us know. We'd love to come back and be able to share with you anything that you're looking for. But at the end of the day, hearing the journey that Barry took from when he was younger, his dad passing away at a young age, military dad, mom that was also an accountant, loving a blue-collar family, and took him down a path where he stood for the little guy. He stood against bullyism, whether it was on Wall Street or in the schoolyard, and at the end of the day, he stands for the truth with integrity. Just super grateful to be part of this, and like I said, if there's any other questions, feel free to ask. Barry, thank you so much for your time today.
Thanks, Rob.
And I look forward to whatever happens next.
Keep pushing back the frontiers of ignorance.
I'm with you, brother.
Amen.
Yes.